is yet to open. That's not 1.5% down. It'll just start to, yeah, there you go. So now it's slightly higher. It's absolutely flat actually. So first rate starting to come through. Mid-cap index is up about 22 odd points as well. Now we'll start to do this, stock spotting, right? What's moving, how much is moving across sectors on the back of GST and otherwise in just a bit. The Nifty heat map is up on your screen. You've got, 35 odd names which are higher. The rest of them are down in the red. And Kotak Bharti on one end, and there is Mahindra and Shriram Finance on the other end. Shriram Finance, by the way, was one of the big losers yesterday as well, meaningful losers yesterday as well. 50 higher on the Nifty now, so 24,545. Surbhi.
Shriram Finance, Prashant, this week has lost about 8%. So perhaps it has something to do with some inputs talking about stress building up in MSME and if there is a second-order effect of tariffs, etc. Perhaps that could explain some of it, but there's a meaningful decline on the stock this week, down another 0.5% today. The other one that's actually started lower is Mahindra & Mahindra. Despite all the positive brokerage notes and Jefferies turning optimistic on the stock, it's opening down about 2%. M&M has also lost about 5%. For this week. But overall, the Nifty is not looking bad at 40 points higher. So let's see what's taking it higher. A whole bunch of consumer stocks. There's Nestle, there's ITC, there is Lever, there is Asian Paints. If you look at autos and names like Tata Motors are doing actually pretty okay. Geo Finance is up about 0.5%. Tata Steel, by the way, there have been reports about China cutting back on its steel capacity to reduce the overcapacity and the glut in the market. That seems to be favoring names like Tata Steel as well. Reliance ahead of the AGM up about 0.5%. So all in all, fairly strong. And Kotak, of course, reacting to the positive brokerage commentary as well, up 1.5%. So overall, it's not a bad start at all for the Nifty. Mangalam.
Not a bad start at all for the Nifty. For the broader markets as well, we have nearly 3 stocks advancing for every stock which is declining. Obviously, it's early days at the open itself, but it's this secular FMCG rally that we're seeing. Colgate is up around 2.5% in the broader markets. We have Dabur, which is 1.5% higher. Godrej Consumer, another one which is about 1.5% higher as well. On the way down, we do have Nykaa, which is down about 2.5%. Paytm is also seeing some bit of profit taking. And thereafter, we have SBI Card and Phoenix Mills, both of them down by about 1.5% and 2 each. PNG Health from the broader markets has been doing well all through, pre-open as well. This month, it's up around 12%, currently sitting with a gain of close to 5%. And we have, some sort of volumes building up on that one too. Relaxo Footwears, there is expected to be some relief coming in at the lower end of the footwear segment for GST, and Relaxo Footwear obviously has the lowest average selling price in the listed footwear universe. So that stock up around 4.5% has been a struggler when it comes to returns to shareholders. So maybe some bit of bump up is what we're seeing from the lows. Bata is another one which is up around 2.5%. Even though the company is looking to premiumize their portfolio, a large part still comes in from the sub 1,000 rupee category. So that stock too is up around 2% right now. Then you have names like Force Motors. Prashant was speaking about the auto space. Cartrade Tech is the other one which is up 3%. And Kitex Garments is the one which has announced, a new plant that they'll start producing from the Telangana plant. So that stock is up around 4% after seeing a big gash this week. It's down about 12% for the week despite the 4% up move that we're seeing right now. By and large, more stocks advancing than the number of stocks which are declining.
No, absolutely. And, we'll spot more as we kind of sort of go along. But it's 24,540 on the Nifty at this point in time. And we're about 30 odd points in the green. Let me welcome in Tahir Badshah, who's with us. Tahir is Chief Investment Officer at Invesco Mutual Fund. Tahir, good morning. Great to have you with us here. We've spent the last hour or so talking about what we broke yesterday in terms of the story, specific proposal from the government to the GST Council on what the centre would like to see. Of course, the GST Council has to decide. What to your mind, Tahir, from a GST perspective, which sector, I'm sure you discussed this internally, what's your thought process? Where will this show up the most meaningfully? And distill it down to sectors from a stock market point of view. Tahir.
Yeah, Prashant, so I think it's quite obvious, and there's been a lot already discussed around this, and we know that essentially the slabs which are merging, which is basically the 28% and the 12%. Those are the ones which are actually going to see the maximum amount of benefit. And by and large, I think what has been conveyed and also been supported by the council is that most of the items in these two categories will move into the other two. So I think by and large it is more or less determined by that some of those products which are in these two categories, basically the 28% and the 12% will be the largest beneficiaries. And I think if you distill it down product wise, the obvious gainers are basically in the two-wheeler and in the auto space in general, particularly as far as two-wheelers and some of the four-wheelers also are concerned, especially at the entry level or the value segment of the market. Those will be obvious beneficiaries. There will be also some of the staple products which will also benefit, although many of these did happen to be in the 5% category. So there will be a relatively lesser number of products which will probably be beneficiaries. But these are the two main segments of the market which should gain as a result of this.
Got that. And as we speak, these are the segments of the market which are doing extremely well as well. The top three gainers right now, as I see, are HUL, Asian Paints and ITC. Britannia thrown in there as well. Obviously not a part of the Nifty anymore. Tata Consumers, the other one, which is higher. So the top sectoral gainer is the Nifty FMCG, which is currently at the high point of trade. Tahir, ever since the budget announcement, the street was expecting a shift from capex to consumption. Do you think that was investable then and is investable now as well? Or do you believe that money will be made only as of now in the capex plays, given the sort of problems that overall consumption, especially at the staples end, is facing right now and the valuations at which these stocks are trading?
So Mangalam, when the first benefits were announced as far as taxation were concerned in the budget, that was essentially a bit of a starting point as far as a move towards consumption is concerned. It did not really happen at the expense of industrials to a large degree. It did for a while, especially during the time when we had that bit of the slowdown shock, and that the public spending was a little weak as well. But I think since then, since let's say the start of this fiscal year at least, we've seen even the industrial segment do reasonably well, thanks to the fact that even the government spending has held up pretty well during this period. But now that we are, we have this reasonably big boost coming on account of GST. There are still a little bit of question marks as far as the funding is concerned, and to that extent, it needs to be seen as to whether the government has enough levers in the budget to be able to kind of support both the segments. I would like to think that at this stage, it should be possible for the government to support consumption as well without actually deviating significantly from the fiscal path, especially if we were to probably avoid the tariff-related hit. I think if that were to probably also compound as it looks like as we stand today, then probably things get a little tougher, and we'll have to see as to where the government's priorities lie, whether they have other avenues to be able to kind of make up for the shortfall and support both the segments so as to make it a twin-track economy.
Okay. Got that point. By the way, I'm just looking at the fall on Mahindra and Mahindra. Stocks down about 3%. There is no fresh news as such. And this could be a complete off-tangential shoot, but let's not forget that there are very, very big political meetings coming up over the weekend, the SCO summit, and Prime Minister Modi's bilateral meeting with his Chinese counterpart as well. And a lot of thoughts have been tossed and thrown up in the air, including the possibility of opening up to more Chinese investment. Could it something like BYD be making in India as well? Again, this is all conjuncture at this point in time till we have anything definitive from those meetings. But perhaps that could be at the margin, something that is kind of in people's mind this morning. M&M down about 3%. Tahir, hi, morning. And actually, let me toss that to you. Maybe it's a question slightly ahead of time. But it's very, very clear that while our trade relationship with the US has gone into a cold storage, there is clear momentum and clear effort to revive a trade and business relationship with China. Now, do you see any implications, even at a broader level, at a surface level right now, for the listed ecosystem, whether it's our electronics companies, Amber and Dixon's of the world, whether it's automakers? How should one start thinking about this? Because the shift seems to be in the making.
Yeah, it looks like clearly, and obviously it is born out of some of the circumstances which are surrounding geopolitical environment today. And I think at one level it is perhaps a bit of a shift in our own policy as well. And I think over a longer term, it should hold up well. It should probably take away some of the shadows which surround Chinese investments and ability to probably have bilateral trade at a more meaningful level. It also probably lifts a little bit of the constraints from a few of the industries, some of the manufacturing-oriented industries, in order to be able to source raw materials and so on, so components, etc., as you mentioned. So I think it will free up some of the the supply chains which otherwise could have probably impacted India even more. I think we know that there are we probably are at this stage likely to see two supply chains develop around the world. They're already developing around the world, essentially. One is a US supply chain, and the one which is centered around China. And I think we'll probably have to see as to how we want to align ourselves. We've been significantly aligned on one side, and maybe we want to probably, there are some of these overtures that we are making in order to make sure that we are part of both the supply chains, at least for the foreseeable future. So I think diplomatically, it is a good move, in my view.
Tahir, absolutely, completely agree. But is there a risk of Chinese products undercutting Indian products? I mean, what's worked in many sectors, and these are high P multiple sectors, right, is import substitution. And if we are going to get stuff from China, they're going to get stuff from us. And I guess the market access here is a big one. Any thoughts?
I would think that, there are much of what we actually import out of China is essentially more of the raw materials, intermediates, certain components, etc. And that, I think, should not necessarily hurt us in terms of, it affecting some of our local manufacturers, at least some of the finished goods product manufacturers. And in certain areas, we also have reasonable safeguard duties in order to ensure that, pricing is not hit in the local market. So we'll have to see how that goes. But it's at this stage, Prashant, as you know, it is very incremental. We are seeing defreezing happen at in things like ability of Chinese professionals, Chinese nationals to be able to access India, to come to India, to be able to support some of the local manufacturers and so on. So that is the level of thawing of relations. We'll have to probably see how that further develops. But I don't fear that as much at this stage.
Right, we take that point. Tahir, in as many words as you can say without spelling out individual stocks, I have to ask you about Ola Electric. That definitely has been the stock of the month, up around 38%. The reason why I say that is because, one, from a government standpoint, there is the push that is coming in on two-wheelers and two-wheeler ownership. And the second part is the push that is coming in on electric vehicles as well. Add to all of this, the underlying fundamentals of the company, at least from what we saw in the first quarter results, seem to have been improving, along with the additional benefits that they get from PLI as well. Now, this is a high-risk bet. The stock has already seen a correction. Despite the rally that we've seen of 38% this month, the stock is still half from its 52-week high. How would you approach a space like this, which is fraught with risks, but, has seen such big moves?
So I think there are a couple of players which are, investment opportunities which are there in this space. And while we may not necessarily, as a matter of disclosure, have any exposure to Ola Electric in our portfolios, but we, again, as a matter of disclosure, we do have, exposure to, let's say, something like Ether Energy in our portfolio. So I think, by and large, we just to convey the point that we are optimistic about the space, and there will be players whom we'll back depending upon where do we see the strategy to be well placed, and the growth opportunity is still there in our view. So I think there's one segment which has held up reasonably well in the market for much of the players, even over the last some time, despite the fact that there's not really a big push as far as any other incentive is concerned. Of course, the government is now once again a little more amenable towards the segment, but otherwise it is having its own momentum simply because it is now trying to gain a larger part of the market share in the two-wheeler space.
That's on the EV side, Tahir. What about overall renewables and solar? Because there's a big fierce debate out there, and we've got a new listing that's just happened, and then there are companies like Wari, etc. And the debate is whether this is going to be only a short-term story till there is just overcapacity in our market. Of course, the companies say that they have a long runway of growth, but what do you believe in?
So I think it will be a typical scenario where we will probably see a burst of growth for the first 4 or 5 years, maybe the first 5 or 7 years, perhaps if not more, and then probably the growth will kind of uh, uh, maybe level out and trend more towards averages. So I think it's a typical scenario of businesses which are in the early stages of the growth cycle, and those will be there will be obvious beneficiaries. But I think these are also segments which have got other complications, especially with regard to imports, and and in that regard, we also know that some of these stocks have done well recently, simply because of the fact that we have moved closer to China, and once again that dynamic is at play out here in the very short run. But I think we are taking it step by step. We think that many of these companies, especially in the renewable space, both the product manufacturers as well as the EPC companies are in for that benefit of that very short, very strong burst of growth in the next few years, and then obviously we take it from there.
Right.
Okay, all right.
Tahir, thank you very much for joining us. Good speaking to you. I just want to, I'll toss to you. Just a quick word. And this is, basically pre-positioning or whatever you call it. The auto index is the top losing sectoral index right now. So stocks are up between 15 and 20% if you look at the August series. So in anticipation to the GST cut, stocks, I mean, auto parts, autos, everything, OEMs, so 1% lower. Guess what the index which is the up the most, it is FMCG. FMCG index is up about 1.5%. And here you've got Colgate, which is up 4%. Britannia is up about 3%. HUL is up about 1.5%. Godrej Consumer is up 2%. Dabur is up 2%. So, buy the rumor, sell the news. I mean, that kind of story playing out, at least as far as auto is concerned. Clear, a big run over the last 1 month.
It looks like
if you see the auto index over the last 1 month of, August, it's been up 5-6%. So therefore, now the profit taking perhaps setting in. And, like I was saying earlier, the law of diminishing marginal utility. So perhaps some shift happening to FMCG.
So perhaps some shift happening to FMCG, but for FMCG, it's more not by the rumor and by the news as well. This is just, there has been an underlying shift which everyone is expecting to come by for the FMCG space. And it has to be, put in context with the kind of underperformance that
Absolutely.
the FMCG stocks have seen as well. So we've been talking about the fundamentals of the sector, seeing some signs of improvement for the last 2 quarters.
And that was this whole conversation was on even before the 15th of August, before that speech.
Yes, so which is what exactly, is playing out in the FMCG space. But a couple of stray moves, particularly on Colgate, I'd like to bring, everyone's attention. The fear of the street was, and as, reported earlier as well, that maybe there would not be any incremental cut coming by on toothpaste. So it'll stay at 18%. But now the TIMSI has said that it's going to come down to 5%. There is an extra relief that is coming on that. But we also need to, again, put these things into context with regards to the penetration of the category. It's not that if my toothpaste becomes 2 rupees less, I will brush 4 times a day. The underlying demand situation has to be kept into context.
दो बार तो बनता है.
दो बार तो मतलब वैसे भी.
Buy more paste and brush more.
Irrespective of the price, you do that.
Okay, actually on that note, let's get to the experts. I mean, GST is absolutely dominating headlines this morning. And we have 2 subject matter experts now joining in to talk about what this could really mean. We have Najib Shah, former chairman of the Central Board of Excise and Customs, as well as Prateek Jain, who is partner at Price Waterhouse. And of course, he looks at indirect taxation very, very closely. Gentlemen, thank you very much for joining in. Mr. Shah, if I could start with you. I mean, it really is a bonanza when perhaps there were not such big expectations. The slabs being moved down from 4 to 2 and having that 40% sin rate. Do you think it will do the job? There is going to be some revenue loss, and we still need to see what shape and form that arrangement is going to take between centre and states. But do you see this being revenue neutral, or will there be a significant revenue loss? And if yes, will it be worth it to stimulate the economy?
Yes, to answer you precisely, yes, it'll be worth it. This is something which everybody had been asking for, hoping for, perhaps not as dramatically as it happened. Announcement from the ramparts of the Red Fort and so swiftly thereafter. So there's something which is good. It should stimulate demand in the economy. There will be a revenue loss for the states and the center. estimates vary from whatever 85,000 to 1.5 lakh crores. And that will be something which will be a matter of concern for states. I think the GST Council's meeting will have to necessarily address the concerns of the states. And I have always held perhaps that some degree of hand-holding may be required and necessary. The government also will be closely looking at ensuring that the rate cuts translate into price cuts and are passed on to the consumers, because having taken this audacious, bold step in reducing the slabs, they would necessarily expect benefit to pass on to the consumers.
All right. How much would the impact, as per your assessment, given the data that we have so far, be on revenue, sir? We just want to understand, because the government also has to make this revenue neutral, right? Or maybe have the least impact on the fisc. Prateek, if you could do, some maths on that.
So look, there is a revenue impact, as Mr. Shah said. Of course, the estimates vary. One is hearing about 1 lakh crore as an impact. But, in indirect tax, what happens is that when the rate goes down, it increases the consumption. And therefore, to some extent, the impact of revenue loss is neutralized. So that's one point. Second is, obviously, it will reduce the classification issues and disputes, etc., for the government. If you see, before GST came in, our revenue neutral rate, when it came in, revenue neutral rate was supposed to be around 15%. We have, before the rate cuts, around 11.5%. After the rate cuts, it could be around 10%. Now, at 10%, India would be placed at any other, compared to any other developed or developing economies in the world. And that's a very, very moderate rate to my mind. So there will be an impact. But in the long run, what we have seen with GST and earlier as well, then when you reduce the tax rate, the tax base increases. So hopefully, over a period of 1 or 2 years, you will see actually the tax base increasing further, and the revenue loss to a large extent will be neutralized.
Gentlemen, morning. Great to have both of you here. Prateek, if you can talk some specifics, and we'll sort of go zoom into specific sectors and zoom out as well and look at the bigger picture. But cars, for example, right? And it's been keenly awaited. Luxury cars over 1200 cc over a certain length now will attract 40%. The rate goes up from 28 to 40, but they were the rate was already 40, right? Plus cess. So how does this work? And the cess gets subsumed?
Yes, so what we're hearing is, so obviously there was a rate with GST around 28% plus cess, and depending on the length of the vehicle and so on. In the smaller car, the cess was either not there or very small, right? So 28% there for the smaller cars. For petrol, likely to move to 18%, and diesel likely to again from 31% to 18%. So that's a big one. For bigger cars, there are two possibilities. One is that government might continue with cess in some form, right? Yesterday there was some discussion about is there a national calamity contingent duty which is going to replace cess. We have requested the government that it perhaps makes sense to replace cess and increase the GST rates per se. So if GST rates increases, then it could be 40% for bigger cars, but it will be still lesser, largely, than what you have today. But if they want to impose another cess or kind of a tax in lieu of cess, then more or less the tax incidence could be same as you have today, but it will not be worse off. So what I'm saying is that smaller cars will definitely get benefited from the looks of it. The bigger cars, either the incidence should go down slightly or should continue at the same level that you have today.
So, Prateek, hi, morning. I don't even know if it's possible to model this or not. Maybe I'll ask Mr. Shah as well. But with the changes and the proposal, as we know, in its current form, including things like, for footwear, the threshold might be hiked to now for hotel rooms, it's 7,500. For footwear and apparel, 2,500. Everything below these thresholds will be at 5%. Is there any way of modeling what the demand impetus could be? Prateek, I don't even know how one can kind of come to any sort of assessment, even category by category. Would you have anything on this?
No, look, for the bigger products, I think it's easier to simulate, right? So for auto, you can simulate that, okay, this many vehicles have been sold with the price elasticity and vehicle prices going down by 1.5 lakh. This will increase by so much. Similarly, you can do for air conditioners, some of the other consumer durables and so on. I think it's more difficult in a normal FMCG products like fruit juices and stuff like that. How do you release?
Okay, so let's talk ACs. ACs are basically durables and autos, the bigger ticket items. With the current changes being proposed, which is basically a 10% reduction in indirect taxation, 28% moves to 18%, which is big. By how much would you expect overall demand to be boosted up by? ACs and autos.
I will not take a guess on that. I'll say that it should be a substantial jump, right? It'll also, for air conditioner, also depends as to how the weather behaves and so on.
Sure.
But it should be substantial, right? I mean, 10% cut on vehicles, etc., translates into maybe 1.5 lakh or thereabouts, right? On the price itself.
Take your point. I mean, take your point. It's difficult to put a number to it, but it should be substantial. Take your point.
Then there is the tertiary impact or the secondary impact of perhaps lower rates on insurance and auto parts, etc. as well. I'm not sure.
No, absolutely. On insurance, and which brings me to the larger question of this whole input tax credit business. And Mr. Shah, if you could weigh in on this, many industries are saying keep us in the higher rate bracket, but don't take away our ITC. Insurers have been sort of asking for that. So how should we wrap our heads around this business of the 5% bracket not having ITC? Or would you expect some change there? Maybe offer input tax credit to some degree, even in the 5% bracket, because that's going to be a very large slab now.
It's a classic case of too much of a good thing. Nobody expected this sort of reduction in rates. And this having come, this is going to be a natural corollary is this accumulation of credit. Because it is extremely difficult to ensure that all the inputs which go in the manufacture of a final product are taxed in such a way that they neutralize the rate in the final product. So it's going to be very challenging. There are going to be concerns. I think there are going to be teething concerns, definitely. And the government will have to tweak as we go along and look at those rates. What can be ensured procedurally is to try and ensure that wherever there's any accumulation of credit, to have ways and means of ensuring that the industry is able to access that credit in whatever manner, right? So those are procedural issues which can be looked at to alleviate the concerns of input tax credit accumulation, which is bound to happen in the current scenario.
All right. Thank you so much for joining in and giving us your views on what may the impact be. We'll obviously wait by for the actual document that comes on September 4th and thereafter assess the impact once we have more clarity. Yes.
Maybe I'll just ask Prateek. Prateek, from what we've reported, you think anything kind of stands out to you which perhaps is a problem in the council? Or you think this is all what has been reported already? I thought largely on expected lines.
Largely on expected lines. I'll just say that what happens to the compensation cess? I think that's a big issue because the cess is there in the distribution chain, right? So if I bought a vehicle as a dealer, I have paid cess. Now suddenly when tomorrow I have to bill, there is no cess. So what happens to the cess which is there with me in my books? Will that be allowed as a refund or not? That's number one. Second is anti-profiteering. What are the guidelines which will come as to how do I pass it on to the customer? And how do I manage the transition stock, right? My stock is lying with dealers, with wholesalers, with retailers. So how do I manage that? How do I do stickering and so on? So some bit of guidance from that, from GST Council is expected. But
and on ITC, and also very quickly, if you could weigh in on this whole ITC dilemma, I mean, how can it perhaps best be handled and the transition be sort of smoothened out?
So on the transition, what they could do perhaps is to say that I can make an adjustment as an OEM, so as a company, and do a credit note to the dealers to the extent of tax amount. So I adjust the tax amount, I claim as a refund, and ITC for the dealer is reduced to that extent. So let's say a dealer has purchased something at 12%, he gets a credit note of 7% from the manufacturer. Something of that sort can come in, because if not, then obviously there will be commercial negotiation in that case, because they will want some compensation for the incremental ITC which they're going to carry in their books for some time. So then there'll be additional discounts, etc., which will have to be offered by the manufacturers to the dealers and retailers.
All right. It'll be very interesting to see where this goes. As our guest earlier said as well, the devil will obviously be in the details. But two things are clear. If there is more money in the hands of people, irrespective of what the rates are, they are going to spend it somewhere. So consumer discretionary, just look at Trent, value fashion retailer, up around 3% right now. Again, this is a stock which has been an underperformer in the past. From its peak, it has seen a bit of a decline. 20-25% growth is what the company is guided for sustainably. This month, it's done well. And the second one is Yatra Online. That's up around 5% as well. Avenue Supermarts is the other one, which is up around 1.5%. So you have more money in the hands of people. People will spend it on travel, fashion, and perhaps some of the important groceries.
And let's not forget footwear. Relaxo is hardly relaxed this morning. A stock that Manglam had picked out. Now it's up 8%. Relaxo on the hopes that footwear below 2,500 rupees was going to be taxed at just 5% now. So there you see the GST chartbusters playing out on the screen. Thank you, gentlemen, so much for joining in on that conversation. Very, very helpful and filled with perspective. We do have to take a quick break. Come back on the other side. We'll have with us Sajid Chinoy from JP Morgan to discuss the implications of this 50% Trump tariff on India and the measures from the Indian side, like GST. To what extent can they mitigate the impact?
Welcome back. We of course are trying to get an assessment of where we stand, right? There's efforts by the government to boost consumption, but that 50% tariff from the US, of course, remains a big overhang. Who better than Sajid Chinoy to take us through the thinking and how should we think about this in terms of impact to the economy? Head of Asia Economic Research at JP Morgan. Sajid, good morning. Great to have you with us here. Thank you very much for joining us, and sorry to have kept you waiting. So first cut, Sajid, how are you thinking about this 50% tariff hit? It's almost like a trade embargo for most products out of India to the US. While one hopes that this is not permanent, and perhaps the 25 gets knocked off after some negotiation or something is worked out, but for now it's there. Go on, Sajid.
Morning, Prashant. Great to be here. I think where you ended was the key here. That there are two issues about permanency, whether we're at 25 or 50 for the foreseeable future. At 25%, even though we're higher than our competitors in Asia, we're in the ballpark, and there are other measures you can use to remain competitive and keep your market share alive in the US. At 50%, we're at a distinct disadvantage. And you know the math here. There's about 2.3% of GDP of India's exports to the US. A quarter of that is exempt, in terms of electronics, pharmaceuticals. So there's about 1.7% of GDP that's exposed. But what matters really is the value addition, because many of these sectors, gems and jewelry, have large import content. And the value addition here is about 1.1%. So there's 1% of GDP that's at risk facing the US. Now, I think the couple of important points to make here. One is that even though this 1% of GDP may sound like a small number in the grand scheme of things, as you know, this is concentrated largely in labor-intensive sectors, right? So it's textiles, gems and jewelry, leather, footwear. And so from my perspective, if you're presuming that this is a temporary shock and lasts a few weeks or a few months and not beyond that, the key is to avoid non-linearities, by which I mean the key is to ensure that, economic enterprises in those labor-intensive sectors stay alive and there are no job losses there. Once you get into job losses, then you get down a spiral in terms of knock-on effects on consumption that are harder to reverse. Now, the good news is we have a playbook from COVID. This is exactly what happened in COVID, where, one fine day there was a sudden demand shutdown. And the question around the world was, how do you keep economic enterprises alive? And India has utilized a lot of those tools. And I suspect a lot of those COVID tools will come back, by which I mean, targeted support, both from monetary and fiscal. On the monetary front, it's more about liquidity, it's about regulatory forbearance. And from the fiscal perspective, it's actually more specific fiscal packages for certain sectors. The good news is technology allows you to target these sectors and firms very precisely, because these are all exporting sectors and therefore go through the banking system. So we can target them very precisely. And so I think that's the first order of business. Before we talk about a counter-cyclical response in terms of, GST cuts and monetary policy, the first order of business is, over the next few weeks and months, presuming this is a temporary shock, how do you deploy those COVID-era tools to keep these economic enterprises alive and ensure that there are no job losses?
How much?
Sajid, just to get the numbers out of the way, so 25% India can compete, 50% complete, of course, it's an embargo. 1% of GDP is at risk, but you're saying that 1% is large because the indirect effect is much larger. And you're saying once you get into the cycle of job losses, etc., it becomes much more harder to contain. So immediately urgent sector-wise COVID-like support measures are necessary, right? Over the next few weeks.
That's right, Prashant. I would say days and weeks. And I say this because this is one of those shocks where the costs will, if this gets over in a month's time, that would be a demand shock that we can easily absorb. The longer the shock proceeds, my worry is the more the costs build, because the initial shock is a loss of demand. The secondary shock becomes the hit to employment and then the knock-on effect to subsequent consumption losses because of employment losses. And then the tertiary shock is the longer this continues, that animal spirits, investment, China plus one gets impacted. Now, I'm hopeful, however, that this will not be a very long shock. The good news about US capriciousness is that we've seen this movie before with many other countries where standards have changed over time, and one fine day the US is amenable to striking a deal. So I think the key is, while we are undertaking these mitigation measures, we have to continue talking to the US, keep negotiating in good faith, and hope that eventually wiser counsel prevails on their end.
We take that point entirely. Sajid, just a two-part question here. One, immediately, what in your assessment could be the amount that should be deployed to support these sectors? How much would it cost the government? And then to the second point, you said, boosting methods of boosting consumption. The government has already foregone some amount on account of the income tax cuts that have come by. Then there are the PLI schemes, all those measures to increase, growth out there, losing some of the government revenue. And then there are the GST cuts as well. All in all, the question is, how much would it cost the fisc?
And it's, these are very early days because it's not clear how long the shock is going to last. The longer it lasts, the more it will cost. I think the good news is, because we've got a playbook that we've just used in COVID a few years ago, and given, the tremendous advances India has made on technology and the ability to target, enterprises and certain sectors, this needs to be, I think, a very targeted response, right? And because we can identify which sectors, which exporters. And I think the other element to consider here is that while this is 1% of GDP, the sectors that we're speaking about, the US constitutes a large market share in those sectors. And so I think ensuring that, these firms and sectors remain viable is the key. I think the fiscal costs, too early to estimate what they are, but I'll make a larger point. I think even if it costs the exchequer something in the near term, in the long run, this will more than pay itself back. Because if you're preserving the viability of enterprises, preserving employment, preserving consumption, that will more than pay itself back. Now, you raise a more important issue, which is, if you step back, this is a year where we'll have to manage the fiscal carefully. And for no other reason, because, we'll get a GDP number today, which should be relatively strong, fingers crossed, close to, 7% almost. But nominal GDP today, I think, will be an equally important story. And nominal GDP is expected to soften to about 8% today. you could have a year where the WPI deflator is so soft that nominal GDP this year could be 8% or below 8%. Now, with that kind of nominal GDP, tax collections will need to be realistically assessed. It's hard to get 12, 13, 14% growth in taxes if nominal GDP is at 8%. The good news is we have some buffer from non-tax revenues, but we have to manage the fiscal carefully this year for these three reasons. A, you've got softer nominal GDP. B, you require some targeted fiscal support for sectors under stress. And C, you've got a GST tax cut. Now, the key there again is going to be how much of that is revenue neutral.
Absolutely. And I was just coming to that point, Sajid, to sort of cap it off. I mean, we can't control what the Americans are doing. All we can control is what we are doing, right? So you're saying more targeted measures. So if you could give us some sense of what is the fiscal space for what size of a package of measures for these sectors, A, and B, this GST cut. I was just asking the previous set of guests. Now, the estimates are that the revenue implication could be as much as 1 lakh crore, the revenue loss. It's not going to be revenue neutral. So then again, how does one do the whole balancing act and the adjustment? And will this extra spend, if I could call it, it's a revenue loss, let's just consider it spend, will it do the job of actually spurring the local economy, local level consumption here?
Yeah, that's a great question there. I think let's wait and see. I don't want to presuppose what the GST Council is going to say on September 4th and 5th. I think let's step back. Before we talk about revenue losses, the fact that we're reforming the GST, simplifying it, make compliance easier is a hugely important structural reform. So I think that's the bigger picture here. Right, that you're going from 4 slabs to 2 slabs. If you make compliance easier, I think over the long term, this is unambiguously positive. Now, we need to be a little bit careful about, what the revenue losses are, because this is not temporary support, right? That once you reform the GST, again, another reason to do that is because the ratio of indirect taxes to direct taxes in India are very high. Indirect taxes tend to be regressive at a time when consumption needs support. Bringing indirect taxes down and reducing the cost of consumption, again, necessary, warranted. But I'm just being a little bit careful from the medium-term perspective because, if nominal GDP is going to be lower, then stabilizing debt means you have to bring fiscal deficits down. And the GST tax cut, as important as it is structurally, if there's a very large revenue loss, it's not a one-time effect, it's a permanent effect over the years. So we need to balance both these considerations. How much stimulus should you inject in the economy in a year like this? But how do you preserve fiscal sustainability in the medium term? I'm sure the GST Council will be thinking carefully about how to achieve this balancing act.
Absolutely. But I think the headline out of this interview, Sajid, of course, this very impassioned plea that the government must act and must act now over the next few days and weeks to support sectors which are hit and avoid, the cycle of job losses and, of course, what comes out of that. But I think point very well taken. Sajid, foreign flows have been very, very negative. Continue to be extremely, $4.5 billion in August. Big numbers, right? When in your conversation with clients, the dollar rupee is at a low. What is your sense on the fixed income rupee side? How are things looking?
I think clients don't worry about this for a couple of reasons. One is, yes, the capital account, has been volatile over the last year, FDI flows, debt flows, equity flows. But the fact is India's current account starting points are very benign. We have a year with current account, 0.6% of GDP in the year that just passed. Yes, there'll be some expansion if net exports get hit. If some of that 1% of GDP in value add gets impacted temporarily, the current account could widen. But the fact is that Reserve Bank of India is sitting on a war chest of reserves. So nobody worries about what the BOP implications are because there's plenty of ammunition and plenty of buffer. 2 other quick points I'll make. I think given what's happening in the US, both cyclically and structurally, we're seeing the dollar weaken a lot. When the dollar weakens, it just takes the pressure off, emerging market currencies. If the Fed's going to be cutting, at least for the next couple of meetings, it'll provide relief to emerging markets. And thirdly, calibrated rupee depreciation in the next few months is not necessarily a bad thing. In a world in which, for example, our Asian neighbors have tariffs of 19 or 20%, and let's hope that, we claw it back to 25% or perhaps even lower. You want to get every percent of competitiveness that you can get. And so in a world in which the rupee is in a non-disruptive a gradual way depreciating, it's actually helping India's case on the export front. It serves to partially offset the impact of some of the tariffs. So I think that's a policy choice that we will make, but really no reason to panic on, I think on macro, we can have a discussion on growth and jobs and consumption, but as we've discussed before, on macro fundamentals, when it comes to the current account, when it comes to inflation, when it comes to reserves, absolutely no concerns on India.
All right, that's great to hear. Sajid, fantastic conversation, and I hope Mumbai is listening. I hope Delhi is listening as well. Thank you very much for being here with a very astute sort of observation, and of course, what needs to be done from here. What we'll do is take a quick commercial break here. We'll come back and we'll focus on Mumbai once again. And there's a big conference which is kicking off. The Motilal Oswal Annual Investor Meet is kicking off from Monday. And we have two very busy gentlemen who will join us on the other side. They're right here in our studios. And we'll go across to them on the other side. Stay tuned.
Well, we were talking about the markets having started fairly well. Now it's taken a turn for the worse right now. The frontline indices are mildly in the red. The mid-cap index even more so. The story of the day so far can be summed up in the crisscross lines that come up for you. When we opened the markets, we had 1,500 stocks which are advancing for about 600 stocks which are declining. Now those lines have intersected and we have, 1,400 stocks which are in the red for just about 1,200 stocks which are in the green. That's actually a perfect time to weigh in on what investors are seeking from, everyone, the corporates, the institutions, and the whole ecosystem. So the 21st Motilal Oswal Annual Global Investor Conference, MOAGIC, as we know it, kicks off from September 1. For the curtain raiser, now we have Rajat Rajgaria, who's obviously the Managing Director and CEO, Institutional Equities, and Sachi Shahane, who is obviously the Head of Sales, Institutional Equities, joining us in our studio as well. The conversation was promised. Thanks a lot, Rajat and Sachin, for joining in.
Thank you for having us. Thanks
at
for
a
having
time
us.
when so much is happening, the question is, what would be the top few questions on everyone's mind, and what are you doing to ensure that those questions will be answered?
Yeah. So, this 21st edition of our conference is happening on a very interesting backdrop.
Yes.
The last 1 to 2 months of events have given a lot of reasons for people to engage with companies, with investors, to find out what lies ahead. When we started planning for this conference, it looked like a one-way street this year for India. But I think 2-3 things that have happened. The last quarter earnings have not been that great. We are still grappling with a single-digit earnings growth. Second, I think you are seeing this entire is like for us only in this world. And the third, we are seeing now RBI and government both coordinating very well to stimulate the economy in every possible manner. All these factors have important consequences on every company that comes at the conference. So I think investors would have very directed questions to know from the companies to what extent they get impacted by all of these and what are they doing to mitigate this, right?
I'm curious to know, when you say investors, what are the queries already? What is the participation going to be like from the foreigners?
Yeah.
Because they're the ones who've been sitting at the edges. And in fact, because it became very clear, like you were saying, that India is being singled out, and as it became more and more apparent that we're not getting a trade deal immediately, the selling intensified. It was 17,800 crores last month. August now, it's now almost 30,000 crores. And they're going to other markets. They're going to Korea, China, which is okay.
Yeah.
But what's the sense you have from the foreign participation side?
So, we have large teams from multiple long-only global foreign investors, be it the sovereign funds or be it the largest of the investors, right? But I think, let me give you a flavor that when you look at Motilal Oswal conference, when we say it's a large conference, we have 1,200 plus investors who attend this event. We have closer to 200 companies. But more importantly, our track, which features 16 speakers, and these are speakers from all walks of life, listed, unlisted, corporate expert, right? It's not just about a stock conference. It's about a framework. It's about a philosophy. It's about how do you see this country. This is a century of opportunities. We just completed a quarter of a century, and we all have been benefited from this quarter of the century growth, right? Last 25 years, we grew from a base of 400 billion, 10% compounded, to today reach 4 trillion. Next 25 years, we will grow at 10% compounded on a base of 4 trillion. So imagine you are going to build one India next year, which existed in 2000. I think this conference is about how do we widen our scope of investing so that we capture the bigger opportunities, point number one. And point number two, of course, while the big picture remains always good, in the short term, you have to face the adversities to make sure that you don't get caught off guard.
So foreign participation isn't lower this year at the conference compared to previous years? No, there's adequate interest.
In fact, I would say that the domestic participation is just growing every year, as you can see in the market and as you can see in our conference.
आप सारे FIS को एक conference room में बंद कर लीजिए.
Just lock the door from outside.
अब आप तभी निकलेंगे.
See the big picture.
Per person, $1 million.
Right वाला button दबाएंगे आप.
That's a good idea.
मैंने बोला मत बोलिएगा, but you must have seen Akash Prakash wrote a piece recently saying valuations still kind of high relatively compared to EMs, but he said his point essentially was, the punch to me was, you can't have an expensive market with just 10% kind of earnings growth, which you also alluded to, that earnings growth has been kind of poor. And that is the reason why, and this question, why are FIs such big sellers? And Sajid just told it has nothing to do with tariffs, this 50%, etc. It's earnings growth. We spoke with Rajiv Batsra of JP Morgan, who kind of also identified poor earnings growth as the number one reason. What is your sense, Rajat? Is this a write-off year? Do we need to roll over to F527, which the market anyway will do? What's your sense?
Yeah, I think bang on. The single most reason for our market underperformance is earnings, right? If we grow at 15-16%, 20p is attractive. If we grow at 5%, 20p is expensive.
Right.
Our PE is not going to come down. So if markets will stay here till the time the earnings growth don't happen. Point number one. Point number two, whenever earnings growth aggregate is slow, whichever pockets grow, they get disproportionate premium.
Yeah.
So even in today's market, I can tell you 5 stocks which are still doing very well, and they were not that they are surprisingly doing well. They were supposed to do well because their numbers were doing well. So that's the second point. Third, on the aggregate earnings, I think there are some both structural and cyclical factors which have come together to make this 5% growth coming, right? Like IT, which has always been a bedrock of earnings for corporate India. I think structurally they are into a single-digit earnings growth mode now because of the way businesses are shaping up. But many of the domestic consumption, industrials, financials, they have to come and make up for that. They are in a cyclical low right now. And I'm more positive that the low base of the last 12 months, a lot of the stimulus which has come from RBI already, which will take effect, and the government stimulus which is likely to come over the next few months should at least push our aggregate growth rate from this 5-6% to more like a 12%. Is 12% good enough? That markets will decide, right? But I think the P's are unlikely to contract much. The earnings has to move up for the market performance to return.
So to that extent, then the obvious question is to the corporates that you're getting on the conference. What is the mix of those corporates like? What sectors are they predominantly from? You said unlisted, listed. And what do you think would be, their idea on growth in earnings? I mean, because earnings growth is what will drive the market, everyone will be asking those questions to the corporates as well. What is it that will drive your earnings growth? Because you can, on the one hand, speak about the macros, blame the macros, or benefit from the macros. Eventually, it is your company's doing that will take the earnings higher.
Absolutely. So, I think this year is also a transitory year on many regulations impacting the earnings. For example, if you look at capital markets, you had regulations which came in, especially on the broking side, which has impacted earnings. If you look at, suppose, the GST cuts, we keep hearing there can be postponement of purchases, which can lead to some inventory impact. That will also come in. If you look at the way this tariff thing can kick in, right, this will also have. So I think people will at least try to focus how much impact in the very short term is going to come. But more importantly, there will be some businesses which will weather this very well. We have 180 companies at the conference, but each investor needs just 5 ideas.
That's what. So I was going to ask you, so which are the five fastest growing companies of, let's say, FY27, which will come at the conference?
Or the tracks where most amount of investors have said, okay, this is where we want to be.
I'll assure you, I will come next Wednesday when the conference gets over. And
just to share
something a little more flavor on the companies.
Yeah, so just to share on the question which you just asked, so a lot of interest in logistics names, a lot of interest in consumer discretionary, industrials.
What companies would they be? And you have unlisted as well. So where is...
but these are largely listed names which I'm talking about, where there is, so all the listed names in this space. And as Rajat just mentioned, non-lending financials is again a very big space where there is...
unlisted companies at the conference?
Roughly about 15% of the conference would be unlisted.
And how much of that 15% is up for listing next 1-2 years?
Not at least the next 6 to 12 months.
And from which spaces are the unlisted companies?
Essentially, new age, consumer, logistics. Look, because I think unlisted companies come with a very different perspective to share with investors, right? So we always try to make a blend of at least 15% of the conference to be unlisted companies.
So a lot of interest, you said, was on logistics, consumer discretionary, and non-lending.
Industrials, non-lending financials, and auto anks as well.
What about the IT guys? You said, it's structurally low. I'm sure at this point in time, a lot of the investors would want to know what are they doing to mitigate this AI storm which is coming in? How is it that my IT portfolio can look a lot better? How will the earnings increase?
Yeah. So, in the case of IT first, their corporate access anyways is top-notch. They meet people very frequently. Their quarterly disclosures is pretty high. So it's very little to, again, figure out we still have good participation, but I think businesses are more predictable right now, even though they are slow. In a conference, I think people try to figure out 2 things. Stocks in my portfolio which I think are not going to grow well, and stocks in my portfolio which I don't have which are likely to grow well.
Yes.
So that kind of an adjustment people want to do. I think suffice to say that 1,200 investors, 180 companies, roughly about 15,000 meetings that we are doing, right? Each one of the investors is getting their share of what they want, right? Hopefully, at the end of this conference, they get some actionable to do for themselves.
I asked this question to Ramdev ji just the other day. Yesterday, we had him on, right? And I was asking him what the local HNI money is doing, the non-retail money. The retail money is nicely doing their SIPs and they're keeping the market up. So he was laughing about it. Jokingly, he said that the problem with that money is that it'll be on the sidelines. Jab tak bazaar thanda hai. The moment there is momentum, they'll all quickly jump onto the bandwagon. Yeah. But your assessment, you or Sachi, the one when you talked, because there are large participants as well. So the non-mutual fund domestic money that we're talking about.
So just to share a data point on that, the AIF side, which is largely the HNI and very high net worth retail money, that is seen commitments of almost 14 trillion which is a jump of 14 trillion INR, I'm saying. So that is a jump of almost 20% year on year. This is a data shared by SEBI some time back, and of which still there is a dry powder of almost 8 trillion, which is sitting on the sideline.
8 lakh crores of
8 lakh
HNI
crores.
liquidity
AIF money sitting on the sidelines.
And a lot of the HNIs are interested in not unlisted. That's
Increasingly.
that is
I
where
was just focusing. If you look at today, NSE shareholding.
Yeah.
In the last 5 years, the entire VCP, FII holding has come to India, to the HNIs and the family offices. You looked at the Zepto deal that as a house we did, a large number of HNI. I think a lot of the HNI money, what Prashant is mentioning, is finding way, right? Typically, that used to be the space for private equity or funds that has become for...
I'm not
Family
joking,
offices
Rajat. I was
now.
talking to a venture capital fund in Bangalore, and I was just chatting about strategies. I said, well, looks like some of these guys in Bombay have more companies than we do. They've been in the VC fund for 20, 25 years.
Yeah.
So it's absolutely correct. It's completely transformed last couple of years.
That's something that Uday Kota keeps quibbling about, right? That the second generation is now looking at venture capital investment as against...
No, these are old, 30-year-old veterans in the market, public market investing, who now they're kind of doing backward
So not
integration.
corporate
They're
family
going,
offices, but
finding
investors
companies
who-
earlier and earlier in that sense.
So, we focus a lot on the mutual fund daily flows, monthly SIP flows, right? What we don't capture is the non-mutual fund flows into the equities, which come in multiple forms. Insurance, HNI money, AIFs, etc. That someday, I think somewhere we will...
We get monthly reporting.
Motilal
We'll be
Oswal should come up with a report every
Actually,
month on
it's
the
a quarterly
We will do that. Thank you. That's a second idea. First idea was to lock people into...
No.
Second idea.
The second is the more actionable
It's a
idea.
very doable idea.
It's all the best to you as you organize this massive conference. It's always great to have both of you to kind of sort of preview the conference for our viewers. Really appreciate it, Rajat, Sachin.
Thank you.
Thank you.
Have a
very
good
much.
time.
Thank you. Thanks.
We'll take a quick commercial break here. Don't go anywhere. We'll come back in just a bit from now. And it's the economy with Lata. And there's a lot to discuss. I mean, the GST news break from last night. And of course, the 50% tariff implications for the economy. Srinivas Varadarajan is of Deutsche Bank India. He'll be the guest on the program in just a bit. Stay tuned.
Welcome to It's the Economy. Actually, I'm discussing bond markets. The Bank Nifty has been one of the big underperformers this quarter. This index, Bank Nifty, has fallen 3.3% in the month of August, and it has fallen 6.4% since July 1st. And the reason actually is bond prices. Bond prices have crashed and yields have risen. The 10-year bond yield, for instance, has risen from 6.2% on June 1st to 6.29% on July 1st to 6.35% on August 1st and went to 6.6% on Tuesday. Today it's just adjusted a bit to 6.56, shows every tendency of going up again to 6.6. So while the last quarter banks reported trading gains on their bonds, in the second quarter they are all going to report trading losses, which explains why bank stocks are falling in the first place. Rising yields also make it expensive for companies to borrow from the bond market. And what is surprising is, since June, the Reserve Bank has cut interest rates by 50 basis, but market yields have gone up by 40 basis points because there are no buyers for bonds. To understand why yields are rising, why have buyers disappeared, how do we bring the buyers back, I have with me Srinivas Varadarajan, Managing Director, Global Emerging Markets at Deutsche Bank India. Srinivas, good morning and thank you very much indeed for joining us. Well, first up, why such a paucity of buyers? Why are yields just going up and bond prices tumbling?
Firstly, thank you, Lata, for having me on your show. A pleasure to always chat up with you. I think if you look at the proximate cause right now, and it's a bit of a storm in the teacup, is really concerns around the fiscal bit, right, which is a little bit blown out of proportion. If you look at some of the numbers, the shortfall that the market is talking about, there is a shortfall on account of rejigging the GST slabs of about 50,000 crores. There's a shortfall, a bigger shortfall possibly coming in from the reduction in the nominal GDP growth from 10%, which was there in the budget, to around 9%, given what's happened to the deflator. So that could lead to a net tax revenue shortfall of about 80,000 crores. In addition to that, they could, the disinvestment shortfall, I think, could be around 15,000 crores. So you're looking at a net shortfall of about 1,45,000 crores. To fill this shortfall, you've got a couple of levers already going for you. One is the increase in the RBI dividend of about 40,000 crores, the excise duty hikes that you did on petrol and diesel in April, that can bring you about 30,000 crores. The compensation cess, you can try and there is a surplus of about 50,000 crores, presume 50% goes to the center, about 25,000 crores coming in from the compensation cess. And of course, you can reduce Capex by 20,000 crores. So this kind of all adds up to 1,15,000 crores versus 1,45,000 crores of shortfall. So there's a net shortfall of about 30,000 crores. And 30,000 crores could easily be met in terms of financing that from treasury bills. Remember, the budget had penciled in net financing from T-bills at zero. So you can clearly finance this. It shouldn't really be much of a problem. I think the bigger issue, really, if you go back to the June policy in August, I think the June policy was when, of course, the stance was kind of changed back to neutral. And the guidance was that the bar for a rate cut is pretty high. But if you really look at the August policy, the inference is that the bar for possibly a rate hike, of course, sometime early next financial year is pretty low, because if you look at the forecasts, you're looking at a Q1 inflation forecast of about 490. You're looking at a growth forecast of 660 for Q1 of next year. So effectively, what that tells you, if you smell the coffee, it tells you that the output gap is completely closed, and you actually have a positive inflation drift of 1%. And that leaves you with, plugging this into a simple Taylor rule kind of tells you that the real rates are close to zero. If you need to plug in even real rates of 0.5%, that tells you that the effective policy rates, if those forecasts eventuate, should be 6%. So that's basically a bit of concern that's kind of plaguing the market.
Actually, Srinivas, I've not heard anybody talking about a hike just yet. I mean, if the RBI has looked through 2% inflation, they logically ought to look through 4.9% inflation also. So, I mean, I don't think people are speaking about a hike 1 year down the line or 9 months down the line. The point is, right now, are there any tools or is there any need? Is the Reserve Bank even wanting to talk up the yields?
So if you look at the price action, Lata, since June, there's a lot that's actually been priced in the bond market. Forget about the 10-year bond yield, right? We all know that from a low of 20, it's gone up to 60 and 55 right now, 655. But you look at the 15-year government bond, for example, that's right now it's about 690. And when the easing cycle began in November, it was again 690. So it's, it went to low of about 635 and it's come back up again. You look at the 15-year SDL, state development loans, for example, which is right now at 7.5, which is higher than when the rate cut cycle began. It was 730 at that point in time. So a lot has happened. The market is also aligning itself with steeper yield curves globally, and given what's basically happened. And really coming to hikes, I'm really looking at it from the RBI forecast perspective. So there is information content in terms of those forecasts that we follow pretty closely. I mean, if you really want to provide some palliative to the market today, you can, if I were to put on the hat of an institutional RBI to kind of look at how best to solve the problem that we have right now in terms of high yields, if it is indeed a problem, is at the outset, the Reserve Bank of India conducts monthly switch auctions about 20,000 crores. You can try and reduce the amount of switches that come into the market to reduce the injection of duration, which the market needs to contend with. You could look, for example, to start off by devolving some of the government bond auctions if you want to provide a signal. If that too doesn't help, then maybe cancel some auctions now, but you can reintroduce it back the second half of the financial year if you require it from a fiscal perspective. Or alternatively, why not look at basically an operation twist? If you recollect back in DEC of 2019, RBI had basically started off with operation twist. They did about 20,000 crores, totally did about 40,000 crores into COVID as well. So if you want to basically keep the bank reserve position neutral, then maybe you can try and come out with an operation twist if you want to basically provide a yield signal. And there's one other thought, but again, needs very, very careful consideration, and it's not really an easy call, is, if you want to provide a yield signal, maybe look at, for some part of the CRR, replacing that with open market purchases, right? So you still provide liquidity to the system to offset some of the outflows because of maturing forwards. And at the same time, you're providing a bit of a yield signal.
Mm-hmm. Okay, well, I don't know if the RBI will take your last suggestion because the entire banking community will be on their case. You've promised a CRR and now you're taking it away. The stock market will protest. And I think that will also hurt RBI's credibility. There is no way they can promise something and not deliver it when there is no, big pressing reason. But that is my point really. Is the Reserve Bank worried at all that the yield is at 6.56? Maybe they are not. Maybe you bond dealers are because banks and bond dealers are sitting on losses. But Reserve Bank thinks 6.5 yield is fine. Do you suspect that?
Maybe not. Maybe if you look at the spot yield, it's just moved by 30, 35 basis points. Big deal, right? In the bigger scheme of things, it hardly matters, right? But you look at what's happened fundamentally is that your yield curve is steepened. You look at your 10 cross 15, which is close to zero. It's kind of gone up to about 35 basis points. Your 10 cross 30 is 75 basis points. The yield curve is steep.